The danger in investing doesn't come from taking a risk, but from not knowing the kind of risk you're taking, or marks. In this video, we're going to focus on bear cases about SoFi Technology. I heard a lot of YouTubers, Twitter, X expert and so on talking about SoFi, the future, everybody have it in portfolio. So in this video, I want to focus on the bear cases because so many people focus on the good thing about this company, but let's see what could go wrong, okay? Because on the long run, what drives the performance is the EPS, okay? It's the growth of the EPS and the price that you will pay for this EPS. So keep in mind that I invest on the stock market for the long run, so at least minimum 5-10 years view, if not more, okay? This is really the minimum, 5-10 years. I don't invest to do a performance in 1 year or in 2 years to buy low and say high. I don't try to do this. I try to invest in compounder at a good price. Okay, so keep this in mind. So that's mainly where the bear cases will go to. So the first one that I see is that less growth than expected relative as well to the valuation. Because you can still have some growth here, but with the valuation that they have, they may expect a lot of growth. So if you don't have the growth that is expected for SoFi, you may be disappointed by the performance of the company. Now let's have a look at the valuation, okay? You have the price now, which is around $12. The next earning for 2025 is expected to be around $290 million, okay? You have 1 billion shares outstanding. If you have a price ratio of 20 in the future and the company grow by 20%, the net income, okay, if the net income grow by 20%, which is the prediction, okay, for the next 3 to 5 years, it's supposed to grow by 20% per year. You will do 1.8.9% if you grow by 20% and you have a P of 20. In this area, okay, this banking area and so on, 20, it's a high PE. Generally, bank company, even when it's fintech and so on, you don't really pay at a multiple which is that high. So you really have a big valuation here. If you want to do 10% per year, let's just take the net income from this year, okay? Because they plan to have a decrease on the net income. So let's take 500 million as net income, which is a net income that was for 2024, okay? 500. Here, if you have 20% growth, you will do 13% per year with a P of 20. If you have a P of 15, you will do 7% per year. So the assumption here is like from 500 million net income, you will go to at least, you will grow at least 20% per year and have a P of 20 to do 13%. Let's say to do 10%, it's a P ratio of what? 17 needed. So if you think this is possible without dilution of the shareholder and so on, you may have an opportunity here, okay? If you don't think it's possible, it will be more difficult. So watch out closely the growth rate and especially the net income growth rate, not only the revenue, but the net income as well. The second bear that I can see is you have good growth. You manage to have revenue growing by 10, 15, 20, 30% per year, but they don't manage to keep a good margin and good probability because it's a competitive area, because the mode is not as good, because they have problem, whatever, but they don't manage to keep a good profitability, a good margin. So you will have revenue growing by 15% per year, 20% per year, but the net income will only grow by 5, 10% per year because you cannot keep too much. There is too much spend on marketing, too much spend on operationals and so on. So this may be a problem for the company and you need to pay attention to this because they seem to kind of have this kind of problem. Like the net income now, we became positive. I mean, the company became positive, 498, but next year they're not supposed to, they're still positive, but they are decreasing the net income, okay? So this is something to take in consideration that you may have a decrease in the competitivity, a decrease in operation, and have less operating margin for this, and that can be problematic. If the operating margin continue to grow with the revenue, here it's perfect, like you have a great thing, but this is something you need to take a look at it. Bear number 3 is no moat or not strong enough to keep good market share. It's come with the other one. Like generally, it's because you don't have a moat which is strong enough that your profitability will not go up as well. But you need to understand that it's a very competitive market. Ask yourself, what is the competitive edge of SoFi? Why would I use SoFi? If your answer is just because, oh, it's an app and they make it easy, I'm sorry to tell you this, but this is not a moat. A lot of companies could duplicate this, okay? So if you think they have another moat, if you think you have something else to get with them, then why not? Why not? Maybe you have something. But for me, in my view, I'm not sure that the moat is strong enough, and I don't feel confident about the moat, okay? Beer number 4 is it's difficult to value because the company doesn't have big enough track record. For now, the valuation is higher to peers, okay? Bank and so on is generally a P around 13, 15 eventually for the good one. So higher valuation to peers. And until which point is it actually worth the premium? Until which point SoFi is worth the premium that they have? They don't have a lot of track record, so it's difficult to forecast the net income because you don't know if it's a company that tend to grow their margin like nicely or no. You don't have enough view on the market and everything, so very difficult to value. You may think it will grow by 20%, maybe the revenue will grow by 20%, but the net income only by 10, 11%. You don't know. So I think this is also something you need to take in consideration, that it's very difficult to value. Beer number 5, the weakening credit quality. Like maybe they want to get market share, and so they will accept to have people with less good credit score, people that cannot pay back, people that may have difficulties to pay their credit. So they will accept people with a higher chance to not pay back and to default. And this can be a problem because it means less income from them. It means a lot of operational potential problem because you will need to fight to get those people to pay. You will need to find solution to get this money. And for a new company like this, if you have a big market downturn, okay, not just like the stock market, but if you have a recession, a big problem in the economy popping, they may have more difficulties to face it than Bank of America, JP Morgan, Wells Fargo. And this is something that you need to consider as well. So this is the 5 main beers that I see for this company. If obviously for you all of this is not a problem and you think they will manage to be better than what I said, you should invest. But here's what's the thing that I see. Did I invest in the company? I think you guessed no. For me, the company is too young, okay, and I don't see a solid moat for now. I repeat, for now, I don't see a solid moat. Maybe in 5-10 years, I will see a more clear moat and more solid one, but for now, I don't see it. Again, I don't see myself holding the company for 10 years, so I prefer to pass, okay? I invest only in 10, eventually 15 companies in my portfolio, so I need to be sure. There is thousands of companies, so I need to be sure and to have a clear vision with it. I don't have it with SoFi. Like, I don't have any guarantees, and in 10 years, we'll not have a huge recession. They will almost go bankrupt, and because they will almost go bankrupt, they will be acquired by Bank of America, okay? So this is something to consider. It doesn't mean that the company cannot be great, okay? It's just my view. It's only for me. So maybe you don't have the same one, so maybe good for you and invest. And to be fair, I will come back in 10 years to see how it evolves. Maybe at this moment, I will invest. With 10 years more in the track record of SoFi, 10 years more of earnings, of balance sheet and so on, maybe I will be able to invest, to see more clear in the business, to see more clear in the moat. But for now, the information are too little. So always keep in mind that I build my portfolio to outperform over the long run, not to buy low and say high in a year or two. Okay, I buy with the goal to keep it for at least 5, 10, 15, 20 years. Like the amazing goal would be to buy and to sell when I will die, okay, or eventually to never sell and pass it after a generation. That's the dream goal, let's say. So keep this in mind, and that's all about SoFi. Let me know in the comment section what do you think about this company, if you have it in your portfolio. And if you have some thesis about it that you would like to share, I would be very happy to read, because it will help me to understand again more the business, and that's the goal of this channel, to understand more every business and become better investors.